Hello, let's look at SPH REIT's numbers, and in particular, let us scrutinize the debt profile, because nowadays we're all just obsessed about the Fed rate hikes, right? This is the brief look through the numbers, and the DPU is up 2% from 5.4 to 5.5, quite in line with expectations. Because the safe management measures are eased in Singapore and Australia, so things should be recovering. If not, something is very wrong. NAV is stable, small up actually, which is quite nice to see, right? You don't want to see rising rates hitting the valuations and leading to a lower NAV. So quite nice. The more insight into the NPI and Singapore properties are doing well. I think in local currency terms, the Australian properties are also doing well though. But due to the fall in the Australian dollar versus a Sing, so the Aussie Sing has fallen by the 7% over the past 1 year, right? You can see the translation effect hitting the NPI for the Australian properties in Sing terms. But I think on the whole, the properties are doing quite well actually. This is of course the bigger thing I think, having Australia, which is the rate hike by the RBA, which is smaller than expected I think. If you Google RBA hike 25, you get this kind of consensus, right? That the hike is smaller than expected, and the rationale was that the RBA is concerned about economy, with a bit of a housing bubble pricking fears. You can see the housing prices are falling, right? And then the population is quite indebted with debt. So if you hike too much, then there's gonna be an impact on the consumption. So I think this is one of the first central banks to kind of blink, right, and say, hey, inflation is worrying, but economy and GDP is important as well. This is the cap rate, and it's quite stable from 1 year ago. Quite nice to see, because you expecting some kind of cap rate expansion, right, with the risk-free rising, but actually it's quite stable. In fact, it's exactly the same. Exactly the same. So the valuations are ticked up a bit with the NPI rising. So nice to see. The rental reversion terms are still negative though. I was hoping for some positivity, but I guess it's quite hard to see that happening if the China tourists are not returning, right? So these are the big spenders from China. So for rental reversions to tick up, I think the Chinese have to return, especially for Paragon, right? So, well, but then the rental reversion was like 8% down last year, right? So I guess it's a moderation. This is of course the most important thing, which is the debt management for the REIT. And you can see, well, the good thing is that the gearing is very low, right? Just 30%. So one of the lowest in the S-REIT space. So two main things. Number one, the floating rate, quite high, right? 29%. Second, is that they also have quite a bit of a chunk, quite a big chunk of debt maturing over the next 2 years. So if you add up this column here plus this column over here, it's 330 million, right? Maturing over the next 2 years. So the rising rate will impact the DPU on two fronts, right? First of all, when rates go up, the floating rate terms will be repriced, right? So people with a home loan should understand this very well, right? We have this floating rates, and rates go up, then the interest on the debt will go up as well. So that accounts for 29%. And then when this debt matures, you have to refinance this debt, and this debt will probably be repriced higher as well, right? So what is not clear though is how much of the floating rates are in front, and how much of this floating rate is at the back. So the best thing to happen is for the floating rates to be all in front, so that when you refi everything and it reprices upwards, well, you reprice everything once, right? What you don't want though is for the floating rates to be at the back, because if they're at the back, right, then if you raise interest rates, then the floating rates will be impacted, and then when you refi the maturity of the near-term debt, they will be repriced as well. So you don't want a double counting, right? But it's not obvious to me though how much of it is in front and how much of it is at the back. But I think quite a big portion should be spread over the next 3 years, because if you do the IRSs and stuff, it should probably be 3 years or so. But it's not obvious though, so I'm not very sure. One other thing is the perps that they have, and the reset date is in 2024. So in 2024, you're gonna have quite a big refi exercise of this debt pillar over here, as well as the decision whether you want to call this perp or let it reset. And if they reset it, it's going to be a 5-year SOR plus 2.517%. So 2024 will be looking like quite a big refi exercise. So let us think about the impact of the rate hike on the interest payments and therefore the DPU. So if you look at the interest rates earlier this year, it's like 1+%, right? And then the Fed says they're gonna hold it, they're gonna hike everything to 4.5% and hold it for a long period for the inflation to go down. So let's assume that they hold true to their word and rates will go up to 4.5%. So that's like a 2 plus or 3% rate hike, right? So let's see the impact of a 2% hike on the DPU and a 3% hike on the DPU. Bearing in mind that this chunk, 330 million, is 25% of the total debt they have. So this is the numbers, exact numbers in terms of DI. So you have 330 million of debt to be refied, and if the interest rates go up by 2%, that's 6.6 million, right? If rates go up by 3%, then it's 9.9 million, right? So 6.6 million of out of DI of 154 million, that's 0.2 cents out of 5.52 cents, right, of DPU. So that's a 4% impact. If the rate hike is 3%, then the impact is 6%. So on a pure refi consideration of the next 2 years of debt, the impact will be like 4 to 6%, right? And if you throw in the impact from the floating rates, it's probably gonna be like 1 or 2% more, right, for each stuff. But again, it's not clear how much of the impact is separate and how much of it is congruent, right? So it's probably looking like 5 to 7%, I suppose, or maybe 6 to 8% impact on the DPU. When all rates refinancing is true in 2 years' time, that will be the impact, right? But in the meantime, the impact will be probably lesser than that, right? Because not all of it is going to be refied at the same time. It's going to be a chunk of it a few months, and then another chunk of it in a few months. So the impact will be gradual, but all in after 2 years, that's kind of impact that you're looking at, right? So which is nothing that crazy, right? Well, 5 to 7%. And if you look at the share price performance, it has dropped by like 8% over 1 year, right? So beginning of the year, it was like above $1, right? Of course, there was the offer from SPH, from the consortium who bought over SPH at 93.72 cents. And the closing date was June 30th, right? And it was unconditional. It was quite funny though, because if you see the closing date of 30th June, the share price was still at 94, right? Which is slightly above 93.72. But one day after that, some joker decided to sell it at below 90 cents, which is quite crazy, right? You had like 1 year to decide whether or not you want to accept the offer at 93.72 cents, and you don't want to do it. And one day after the offer closes, some joker decides to sell it at below 90 cents. Like what the hell, man? It's crazy, right? But after that, the share price recovered, and then held at around 93 cents or so. Of course, this is the period of the big sell-off everywhere, right? When everybody is selling everything, right? It was just a crazy period. So at these levels, the units are yielding maybe like more than 6%, right? Trading below book. And the impact of the rising rates on the DPU is like 7 or 5 to 7% 2 years down the road, right? When all is refied and all is repriced, right? So at current levels, is it attractive or not? I think that's something investors should think about for themselves.